Hey everybody, it's Tortoise Investing coming at you today with 4 stocks to put on your radars. One of these I bought today, and that being Salesforce. Salesforce is down almost 20% after earnings. Now, if you're new, please hit that subscribe button. I'd greatly appreciate it. Drop a like and comment down below if you own any of these stocks. All those things help the channel and the videos out tremendously, and I greatly appreciate it. None of this financial advice. Always do your own research for buying. Now, let's take a look at it. We're going to be taking a look at Salesforce, Intuit, which is also down almost 6%, Adobe, which is down over 6%, and Anchor PLC. The one that I did buy was Salesforce. I put $200 in it today. Just free cash flow yield of 4.06%, dividend yield of 0.59%. Now, there's a lot of things that I love about Salesforce, and I am very happy about this buying opportunity. Let's take a look here over last year. We're down 2.41%. Did dip below 200 here at one point back in October 2023. But we got in at 221. If it stays around this price range or drops further, I will add more to this position. Now, Salesforce, revenue growth, 23.95% over the last 10 years. Over the last 2 years, 14.71%. So it is slowing, but still double-digit growth from their revenue. Take a look here, revenue by sector, by segment, growing year over year. And I am more than confident 2024 is going to be another increase in this category. Total performance obligations, as you see, this is also increasing incrementally year over year. And free cash flow, 32% over the last 10 years. That is rapid growth. And stock-based comp is something that they are working on. They have been issuing out quite a bit of it, but as if you look here, free cash flow went up, stock base went down, which is great. Love to see that. EPS growth, 24% over the last 5 years. It looks kind of wonky. They have more cash than debt on hand, which is always beautiful. 14 billion cash, 5 billion in debt. Take a look at the quarterly here. 17.6 billion and 5.91 billion in debt. So even better. And they did issue state that they are starting their dividend, although just 40 cents. I see plenty of growth for this going forward. And shares outstanding, if you take a look here, this is something that had been increasing for a while, but now it's kind of flattened out, and hopefully going forward they can get this share count down and increase their share buybacks with that free cash flow that they're making. And let's take a quick look here at the return on capital employed, 7.88%. And again, this is something that I see this is going to be 20% plus in the next year or two, I feel, personally. I think that this company's got a bright future ahead of them. They are clicking on all cylinders. I could talk about Salesforce to the end of the world, but Intuit's another one I've got my eyes on. At one point, this thing was flirting at the 670 price point. Now down to 562.97. I'm hoping it drops more. Just free cash flow yield 2.02%, dividend yield 0.6%, free, and the payout ratio 32%. Yeah, I'd love to see this to just continue dropping. Revenue 13.17% growth over the last 10 years. That is beautiful. Revenue by segment also growing, as very similar to Salesforce. Revenue by service and product, again, this is also growing and rapidly. And free cash flow, another free cash flow juggernaut, 15.26% growth over the last 10 years. Beautiful. Stock-based comp, they do have it, but the free cash flow is growing quicker than they are growing their stock-based compensation, so that is not an issue. EPS been growing at a rate of 11.52% over the last 10 years. Very nice. Pretty much all of this just up to the right. It looks beautiful. Beautiful little chart. Dividend growth, 16.83% over the last 10 years. Looks like they are due for another hike, so stay tuned. I think that this will be another double-digit increase from them. Take a look here at the quarterly. Shares outstanding, not really going anywhere, but that is okay. They have 4.68 billion cash, 5.48 billion in debt, so not an issue there whatsoever. And the return on capital employed is 13.09% last year, which is solid. Companies usually average around 9 to 10%, so this is above average with return on capital employed. Next up, Adobe. This is another one I am eyeballing very hard. I really like this company a lot. Just free cash flow yield 2.32%, and they also was above 600 and some bucks here. $634 now, down to $445. Oh my goodness. What was that? Nearly $200? Yes, nearly a $200 drop from their high here recently. Yeah, look at that. Down almost 30%. Down over 30%, really. If I'm mathing right. Either or. Revenue's been increased at a rate of 16.95% over the last 10 years. This has took off like a rocket because they went to subscription base. Beautiful. Revenue by segment also growing, trending in the right direction. Total performance obligations growing year over year. Free cash flow growing 21.83% over the last 10 years. Very, very nice. EPS growth 35.67% over the last 10 years. Again, very, very nice. It kind of tapered off a little bit, but I believe that AI is going to help them a lot. They've got some great things with Photoshop, and I'm very excited about the future of Adobe. If this thing keeps dropping, God, I'm absolutely going to have to jump in. Debt, they have $3.56 billion. Let's take a look at the quarterly here. Debt, they have $1.76 billion. In cash, they have $6.82 billion, so a lot of cash flow. And shares outstanding, they've been buying back shares over 2% rate in the last 2 years. This is just decreasing over time. Absolutely wonderful. Return on capital employed over 30% last year. So much to love about this company. And take a look here at the quarter over quarter growth from their revenue. Nuts. Absolutely crazy. How's Salesforce look? Just curious. Very similar. But Adobe's is just straight up and to the right. Absolutely wonderful. Again, another company I've got my eyes on. And lastly, we got Accenture. Just free cash flow yield 3.84%. We got dividend yield of 1.73%. Payout ratio 45%. They are also down pretty big at $386, now down to $284, down over $100. Revenue growth 7.75% over the last 10 years. So, very nice. Over the last 5 years, over 9%, so it's growing. Love to see that. Free cash flow, 11.86% over the last 10 years. Very nice. Stock-based comp, not an issue. It's nothing I'm worried about. EPS, 8.13% over the last 10 years. Over the last 5 years, 11.68, so it is increasing. And the dividend, take a look here. Over the last 5 years, growing at a rate of 15.32%. So they are giving out pretty solid dividend increases as well. And that share count is trending down and in the right direction. You want that to be dropping. Over 1% average over the last 10 years. Has slowed with their buybacks, but I'm hoping that with the pullback, this is something that they start doing more of and get that EPS up even further. And the return on capital employed, even in 2020, was at 26%. We're setting at 26% 2023. So very reliable, high return on capital employed. So those are 4 stocks to keep in the back of your mind, keep on your radar. Like I said, I bought in the Salesforce today. I took the negativity as a opportunity to jump in because recently, as March, this thing was at 316. Dropped $100 in a month. That's just how crazy the market can be at times. Yeah, S&P's up year to date, but we still have things out here. Multiple big name companies that are down over $100 a share. Hope you enjoyed that. Hit that like and subscribe button for more, and until next time, take care. See ya.